Hello and welcome, and in this stock analysis video I will share with you my simple investing process which has helped me get a consistent return of over 20%. So in today's stock analysis video we are going to examine Paycom. First, let's find out about the company. Paycom was founded in 1998 and was later IPO'd in 2014. Paycom provides a cloud-based human capital management solutions as a software service for small to mid-sized companies. During our stock analysis, we're going to explore the key pillars, examine the ownership, look back at past results, we'll find out what the analyst predictions are, as well as giving the business a valuation, and examine the potential return on our investment, and finally we will summarize our findings. Let's start by looking at the key pillars for the trailing 12 months. In the book Rule 1 by Phil Town, he suggests that these are the key metrics when first evaluating a business. The first pillar we are going to explore is the earnings per share. This is where we take the net income and divide it by the shares outstanding. The higher the number, the more profitable the company. The earnings per share has increased for this last 12 months by 40%. Now let's look at the free cash flow, which is the money a business can generate from its operations. Free cash flow is up by just 1%. Then we come to the next pillar, which is revenue, and this tells us how good the company is at generating income before deducting expenses. And revenue is up by just 4%. Book value is calculated by subtracting the total liabilities from the total assets, and this indicates the equity growth for the company. Book value has increased by 12%. Now we want to turn our attention to the management of the business by looking at the return on invested capital and the return on equity. These two measures allow us to assess a company's efficiency at allocating capital under its control. Return on invested capital and return on equity have increased by 33%. Now we move on to debt, and Phil Town prefers a company that is able to pay off debt with their free cash flow within 3 years. Currently, Paycom have no debt. In this next section, we will now focus on other key metrics which will help define an excellent business. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. And their gross margin is an excellent 83%. Next we come to the operating profit margin. This tells us how much profit a company makes on $1 of sales after paying for costs of production, such as wages and raw materials, but before paying any interest or tax. And their operating profit margin is a fantastic 33%. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for a company that has a free cash flow yield of 5% or higher. Free cash flow yield is 2.93%. As we are potential shareholders, we will now want to look at the average book value growth for the last 10 years. This is 22%, with the lowest point being this year at 12%. Ben Miller believes earnings growth is the biggest indicator to a company's stock price. The average growth for the last 5 years is 16%, and the lowest point was minus 21% during COVID. I've included a link if you want to check out the investors page and see the annual report. This is Bitesize Investments, giving you a step-by-step approach to your investment journey. There are currently 2 super investors who own this company. If we look back at Ken Fisher's previous sales and purchases, we can see he has both bought and sold shares in Paycom over the last few years, and has increased his stake in the last 2 quarters. In addition, there have been no super investors who have sold in the last quarter. Now we look at the past historical prices of the company, as this will help us build a picture of periods of success or failure the business has been through. If we look back at the past performance of Paycom, we can see from 2015 until 2021, Paycom's share price was making significant gains year on year. However, over the last 3 years, their share price has been dropping just as quickly. On average, the analysts believe the price target should be about $221, but some believe it can go as high as $427. Analyst reports suggest that Paycom is greatly undervalued at the moment, and the overall consensus is that Paycom is a hold. And currently, the analysts believe the company will continue to grow between 5% and 34% over the next few years. So I will use the current earnings per share of 8.25 as my starting point when creating a valuation. Based on a combination of past growth and future analyst predictions, I'm going to estimate the earnings per share will grow by 15%. I'm going to give Paycom a PE of 28. After that, I'm going to project these numbers forward by 10 years. This gives me an estimated future stock price of $934 per share for its future share price. Then we need to include our 15% return. Now we work at the current value that Fieldtown calls the sticker price, which is $230. Then we can apply a margin of safety. At 50%, this gives me a buy price of $115, and at 25%, this gives me a buy price of $173. As we can't rely on just one valuation model, I'm going to dig a little deeper and gather some more information. If you found this video useful, click on the link to check out my last stock analysis. In this next section, I'm going to get some help from some super investors. To start off with, I will use the Peter Lynch PE ratio model to help determine if the share price is overvalued, fairly valued, or undervalued. So we take the share price, add the dividend yield, and divide it by the current PE ratio. Using this valuation, it suggests that Paycom is incredibly undervalued. Then we're going to move on to Warren Buffett's 10 cap model, where you divide the free cash flow with the market cap. The higher the percentage, the more the company is undervalued. Using this valuation, it suggests Paycom's only a little undervalued. After that, we're going to move on to Joel Greenblatt's favourite tool for working out if a company is correctly valued, which is dividing the enterprise value by the earnings before interest and tax. Using Joel Greenblatt's method, this suggests it's undervalued too. Finally, I've also included Fieldtown's earnings per share growth model that I used earlier. Using the Fieldtown earnings per share growth model, it suggests that Paycom is a buy at the moment, but only if my assumptions are correct. Therefore, I'm going to look at the stock chart to help gauge which zone Paycom is currently in, as I need to decide if Paycom is recovering or if it could drop even further. If you're interested in reading any of the books by the super investors I've mentioned today, please look in the description to find out more information. Based on the book The Lunchtime Trader, I'm going to split the 5-year stock chart into 4 zones to determine the current movement of the company and to help identify key indicators such as when to buy and sell the stock. Our first zone is a market bottom for Paycom, and we currently seem to be in it at about $173. However, at the start of the pandemic, the share price dropped to about $160. Then we come to Zone 2, which is between $190 and $288. Then Zone 3 is between $288 and $370. And finally, Zone 4 is our potential exit strategy when the companies become overvalued, with a target price of over $370. But to be honest, I would personally be looking to cash in on the stock price reached $210 or $220, as I don't think the company will reach the pandemic heights again, or at least not for a very long time. The return we would receive if we bought at the 52 low of $159 and sold at the market high of $374 would give us a return of 135%. We could see a return of 116% if we bought at our margin of safety price of $173. From 2015 to 2021, Paycom's share price went from $26 a share to its peak of $547 a share in 2021, and in my opinion it's unlikely to hit those dizzy heights again, or at least for quite some time. But during that time it allowed them to create a narrow moat and gain about 13% of the HCM market. In recent years, they've had their reputation damaged by a significant data breach, and it brings with them an impending lawsuit. And more recently, their launch of Beti, an AI automated payroll system, has led to cannibalization of their own services and revenue streams, as clients have started reducing their spending on Paycom services because Beti was making them non-essential. Basically, Beti was too good at its job, and Paycom has ended up shooting themselves in the foot. However, looking at Paycom's key metrics, they are still an incredibly good company, which is suffering from a couple of events that have given them some temporary setbacks, which I believe they will be able to recover from. If you've enjoyed the video, it would be greatly appreciated if you would like and subscribe to help the channel grow. And finally now, we'll summarise what we found out about the company. When reviewing the key pillars, Paycom scored 9 out of 12. Under ownership, 2 super investors have bought in the last 2 quarters, but none have sold. Historically, the share price hit some fantastic heights, but is currently in a downward trend. Analysts are predicting that Paycom is a hold at the moment, and they're predicting they will grow between 5 and 33% over the next 5 years. But my own analysis suggests that there's more likely to be between 12% and 22%. Using the different valuation models, my personal buy price would be $173 or less, and for full disclosure, I've bought Paycom at $172, although this isn't a recommendation for you to do the same. Paycom have a narrow moat and own about 13% of the market, but have had problems with their AI product Betty and have had a data breach which has caused a significant stock price drop. However, these events seem like temporary setbacks and they should be able to recover from them. My final overall rating is 5 stars out of 6, and I've given this a category A rating within my own stock watch list, as many of the metrics are incredibly good and the revenue and earnings are increasing year on year. Thank you for joining me during this stock analysis video. As I'm a relatively new channel, please consider using the comment section to help me develop the content I am creating. And don't forget to like and subscribe.